Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Hope you guys are doing fantastic, and once again, happy Friday. Well, interest rates finished the week again worse than where they ended last week, and it's been a pretty tough run here over the last 3 weeks. We've seen interest rates get worse by almost 0.5%, so it's been kind of difficult. Now, financial markets will trade on a number of different things. You know, I always talk about the economic data, and so that's one thing that will move financial markets. Other thing, global events, but also a very important aspect to how financial markets move are based upon just trends and technical signals. And last week I talked to you about a very important technical line, which was the 200-day moving average. We came very close to breaching that important level of support for interest rates last week, and we did breach that this week, and that's a pretty big deal. Just like a dam, when it springs a leak, it really affects the whole structural integrity of that dam, holding back maybe a massive movement in water. And the 200-day moving average works just like that. We were trading in positive territory above that 200-day moving average, and that would be a good thing for interest rates. And now we've broken beneath that, and there was a couple of days where we actually stayed below those levels. Now, good news is today we've moved above that 200-day moving average, and so hopefully we can hold that for a while. But again, a leak has been sprung, and that is a very important signal. Despite interest rates have gotten worse, despite really a whole lot of economic data that really should have improved interest rates. We saw retail sales come in weaker than expected. We saw producer price index come in weaker than expected. We saw consumer sentiment come in weaker than expected. And we also had some very good treasury auctions, which all those things typically would have been good for interest rates. But because of that technical trend that we broke through, that 200-day moving average line, that really caused interest rates to get worse. And so things are going to be really volatile here over the next few weeks. And right now the stock market is continuing to be at record levels, even despite some of this weak economic data. So that's why interest rates are getting pressured. And this breach of the 200-day moving average could be an early signal that maybe the trend for these lower interest rates that we've been in over the last about year could be approaching its end. Now, that is not a guarantee. It's just a big harbinger of potentially maybe things to come. Now, there's a couple of things that could change this. Again, we're seeing the stock market again at record levels. So if there's a falter in the stock market, that would send money back into mortgage-backed securities. We also have seen that global yields are rising a little bit, so if there's a change there, and the dollar actually has not been as strong, so if the dollar gets stronger and global yields go down, we'll see interest rates benefit. But also the real big, and this seems counterintuitive thing, is that if we see the Federal Reserve increase the short-term credit, that could actually cause the stock market to suffer and interest rates to improve a little bit. But right now, we're just going to see a whole lot of volatility. So tell your clients to lock, tell them not to gamble, get these interest rates while you can. It's a really good thing, and we'll always keep you informed, but it's going to be a pretty rough ride, I think, and a very volatile next at least month, and we'll keep you informed as always. If you're working this weekend, so are we. Let me know if there's anything that we can do to help. Thanks for joining me with Java with Jared, and we'll keep you informed as to if this leak gets any bigger or not. Have a great day. Happy weekend. We'll talk to you soon. Bye.